Required, prepare CCA's contract account for their ending 31st December 2023. 7 marks. Now, contract accounts are prepared for those businesses which are engaged in the construction projects like construction of buildings, bridges, roads, dams, etc. So in this revision session, I'll show you how to prepare a contract account, how to balance it off, what do we debit, and then what do we credit. So I'm using the May 2024 question paper. This is question 6, part B, because part A is about the least squares method, then part B is about contract costing, and it's what I'm going to use because I want to show you how to come up with a contract account, and then we see how we can balance it off. So question 6, part B, May 2024. That is our question for today. CCL has experience of over 10 years in civil works. CCL was awarded a contract to repair 6 kilometers of Kampala Jinja Highway from Seta to Mukono. The agreed contract price is shillings 12 billion. The contract price is very important in this question, so it's key you can underline that. Of which 7.2 billion was transferred to CCL's account after signing the contract. The contract commenced on 1st January 2023 and it was expected to run for 12 months. By 31st December 2023, the following transactions had occurred in relation to the contract. So we have the quantities and their unit costs. These are the transactions that occurred in relation to the contract. We have Maram on site, the sand transferred to site, cement to another contract, unused sand. You have the labor hours taken, the paid and the unpaid, so that's the total of 24,000 hours. We have the mixing plant that was purchased, a road roller returned to store at cost. So that is the information we have. But of course, you have some additional information down there. Work issued with a certificate of completion amounted to shillings 8.16 billion, while the work not yet certified but completed was amounting to shillings 840 millions. Plant and equipment is depreciated at a rate of 20% per annum. All plant and equipment were bought on 1st January 2023. Outstanding labor hours yet to be paid was 4,000 hours. We are required to prepare a contract account for their ending 31st December 2023. Now, under contract costing, that is a specific order costing technique, don't forget. Now, under contract costing, we prepare a separate contract account, which is maintained for each individual contract. Now, this is an individual contract of constructing a road. So we have to prepare a contract account for this individual contract. Of course, when it comes to contract costing, all costs incurred in order to complete the contract are charged to that specific contract. During the construction work, costs will be incurred. You'll see direct expenses, the direct materials, the direct labor. You'll see such expenses. You'll see overheads given in the question. Contract plants and machineries will be used. So they will be purchased and they will be used on the contract. So I'm going to show you how to prepare a contract account, how to balance it off, and then we shall also discuss some other issues when it comes to arriving at the notional profit and then the profit or loss that should be taken in the statement of profit and loss as at the end of the year. How do we prepare a contract account? Just like any other account, a contract account has debit and the credit side. So contract account. So this is my contract account. The amounts are in shillings. So that is our contract account. Now what we have to do is to start entering the information. Remember, I've told you that all the direct expenses will be debited in this contract account. We have Maram on site. We have 8,000 tippers, but each tipper is valued at 175,000, the unit costs. So Maram on site, this is a material which they will use in the construction of the road. So this is going to be debited in our contract cost, in our contract account. So Maram on site, Maram on site. So how do we come up with the amount? As I've told you, you'll debit the Maram on site. We have been told that there are how many tippers? There are 8,000 tippers. So 8,000 tippers times the unit cost of each tipper, which is 175,000. 175,000, giving us that. I think that is 1.4 billions. Then the other item to debit, sand transferred to site. This is a material which they will use. Sand transferred to site. That is a debit. There are how many tippers? There are 12,000 tippers. So 12,000 tippers times the unit cost of each tipper. That is 250,000. That is 250,000. Then cement to another contract. Cement to another contract. Cement has been transferred to another contract. So if cement has been transferred to another contract, then we have to credit this. This is not, of course, it does not belong to this particular contract. So in our contract account, what we are going to do, we are going to credit, because it's like there was cement specifically for this contract, but it has been transferred to another contract. So what we shall do, this will be credited in this particular contract. So cement to another contract. Cement to another contract. And that will be credited. There are how many bags of cement? These are 2,000 bags. But of course you multiply these bags. The unit cost is how much per bag? That is 40,000. So times 40,000, giving us that. Then you have unused sand. The unused sand. This is like the sand on site at the end of the accounting period. We have to value this at its cost. There are 150 tippers, but each tipper is 250,000. So this should be credited. Unused sand. Unused sand. 2,000 tippers. 2,000. 150 tippers. 150 tippers, that each tipper is 250,000, giving us that. Then what else do we have? Labor hours taken, paid and the unpaid, 24,000 hours. But of course, some hours were paid for, others were unpaid. So what we have to do, we have to charge the full labor cost to the contract. You can either split and break it down by showing the labor hour, the direct labor cost paid, and then maybe you can also show the accrued for the 4,000 hours. But at the end of the day, you still show that you're debiting your contract account with a total of 24,000 hours at 75,000, though 20 were paid for, then the 4,000 were unpaid, the accrued. So what I'll do, I'll just debit the contract account. I'll say direct labor cost paid. Let me break it down, but you can still put your 24,000. So this is 20,000 hours they paid. What is the rate per hour? 75,000 times 75,000, giving us that. Then accrued direct labor. Accrued direct labor, because the 4,000 hours were unpaid. So 4,000 times the rate per hour, which is 75,000. What else do we have? The asphalt mixing plant purchased at that. So the mixing plant that was purchased, of course we have to charge it direct to the contract for which it was purchased. So we come and debit the contract account with the cost of the mixing plant. Mixing plant, its cost is 145 millions. 145 millions. Then what else do we have? It's a mixing plant. The other item is a road roller return to store at cost. A road roller return to store at cost. Road roller return. So we credit the account. Road roller returns. Return to store. Road roller return to store. But of course at cost its cost is 78 millions. But remember, these plants and machineries are depreciated at a rate of 20%, and they have told us that all plant and equipment were bought on 1st January 2023. So we have to get the value of this road roller that was returned as at the end of the year. Remember, the depreciation is 20%. Depreciation is 20%, meaning that I can simply get 80%. Okay, that is excluding the cost that has been depreciated, or the amount that has been depreciated. So that is 80% of the cost of the road roller, which is how much? What is the cost of this road roller that was returned? 78 millions. So I'll just get 80% of 78 millions. That is the same as getting the cost of 78 millions minus 20% of 78 millions. So road roller return to store, that is that. Then additional information. Okay, but of course, even the mixing plant, we have to get the mixing plant at site. The mixing plant at the end of the year. Mixing plant site. It should also be depreciated. Its cost is 145 millions. Still, I will get 80% because all assets are depreciated at 20%. So 80% of 145 millions. What is its value? Its value will be 116 millions. So that is the contract account. Based on the information which we have, that is our contract account. So we have to balance it off to see the cost that has been incurred to date. We have to come up with the cost incurred to date so far. Okay, so the cost to date, carried down. How would we get the cost to date? We add the debits. We are trying to balance up the account. So that's what we have. Of course, to get the cost incurred to date, I'll get this minus this, and that to come up with our balancing figure, which is that. Then, of course, after our debit will equal to the credit, having inserted the balancing figure. So the cost incurred to date is there. That is our cost incurred to. That is our cost incurred to date. Now we need to see how we can come up with the rest of the information in this account, because it's not yet complete. We have to arrive at the profit. So that is our cost incurred to date. So this cost incurred to date is brought down on the opposite side. Cost to date brought down. So we bring it down on the opposite side of the account. Then we have to get the value of work that was certified. Work certified, that is the additional information. We have been told that the value of the work certified amounted to 8.16 billions. Work certified, that is 8,160 billions. That is the value of work certified. Then you also have the value of work not yet certified. The value of work not yet certified. The value of work not yet certified, that is 840 millions. That should also be credited in the contract account. Value of work not yet certified, that is 840 millions as per the question. So we credit the 840 millions. We credit the 840 millions. Now what we have to do, we can come up with what we call the notional profit as the balancing figure, and that notional profit will appear on the debit of the account. Notional profit, that is the value. To arrive at the notional profit, we get the difference between the value of work completed, where the value of work completed include the value of the work that has been certified, and the value of work that has been completed but not yet certified, then minus the costs that have been incurred to date. So the balancing figure in this account so far now at this stage, that is the notional profit carried down. So let us balance up the account and then we see how much is our notional profit. How much is the notional profit? Notional profit will equal to the value of completed work, then minus the cost that has been incurred to date, giving us 2,950,900,000 as our notional profit. That is the profit on the contract. That is our profit on the contract. However, we have to find out the portion of this notional profit that is going to be transferred to the profit and loss account. So we bring the notional profit on the opposite side. So that is notional profit brought down. We bring it down on the opposite side of the account. Then we have to find out that portion of profit that is going to be recognized, that is going to be transferred to our profit and loss account as at the end of the year. But of course, I'm going to show this in the workings. So that is working. I'm going to show that. Then of course, there will be a profit provision. There will be a profit provision carried down. That profit that will be transferred to the reserves since the contract is still running. Now, how do we arrive at the profit and loss account? The profit that will be transferred to the profit and loss account. Remember, this is a contract that is still running. We need to see so far the percentage of work that has been completed. We need to look at the percentage of work that has been completed. Now, when the contract extends over a number of years, it may be necessary always to take a profit each year in order to avoid the wide fluctuations in annual profits. So there are rules which we normally follow when it comes to arriving at the profit on uncompleted contracts. So we have to find out the percentage of work that has been so far completed. Thereafter, we can look at the rules, then we see which formula or which rule we can take. So I have some workings down here. Workings. In this working, I'm going to show you how to arrive at the percentage of work completed. So it's what I want to come up with, the percentage of work completed. How do we get the percentage of work completed? We get what we call the value of work certified over the contract price. Over the contract price. Then we shall multiply that by 100% to arrive at the percentage of work completed. Therefore, our percentage of work completed equals to the value of work certified. What is the value of work certified from our contract? That is the percentage of work certified So that is the work certified, which is this, over the contract price. How much was the contract price? The contract price was how much? 12 billions. Over 12 billions. Over 12 billion. So that is 0.68. 0.68, if I express this as a percentage, that is 68%. So 68%, that is the stage of completion so far. The contract is 68% complete. Now, what profit do we take? When you look at the 68%, you'll see that this contract is in its maturity. It's not nearing its completion, but it is in its maturity. So there is a formula we use if the contract is in its maturity. So the contract is in its maturity stage. The contract is in its maturity stage. So which formula do we use in that case if the contract is in its maturity stage? So the profit transferred to the profit and loss account. So the formula we use, we get 2/3 times our notional profit times the notional profit. Then you get the cash received. These formulas you need to learn them. Cash received, then over the value of work certified. That is the formula we use when it comes to arriving at a profit to be transferred to the profit and loss account when the contract is in its maturity stage. If it was nearing completion, there is a different formula to use. So you always have to come up with the percentage of work that has been completed for you to be able to arrive at the profit to be transferred to the profit and loss account. So this is 2/3 times my notional profit, which is that, times the cash that was received. How much cash was received? Let's check. That is 7.2 billions. 7.2 billions. Then times, okay, that is the cash received. Then over the value of work that was certified, which is this, giving us this amount. So now this is the profit to be transferred to the profit and loss account out of our notional profit. That's how much we shall take to the profit and loss account from this working. Of course, now the profit provision. Profit provision carried down, that is the difference out of the notional profit minus what we have transferred to the P&L. So this is the profit provision. This will be taken to reserves, and it will be recognized or realized when the contract is complete. So this is our contract account for this particular question. Yeah, so that is your contract account. The workings are very clear. Just in case you have questions, please share them in the comment section. I'll answer them. Thank you for watching. I remain your accounting tutor, Senior Hannington. Bye bye.